In finance, a trading book is a collection of financial assets held by a firm specifically for active trading and short-term profit. Think of it as a specialized, active portfolio that is kept separate from a bank's long-term, stable investments. These books are built for speed. They track assets that can be converted to cash rapidly to capitalize on immediate market moves. The contents are diverse, ranging from common stocks to complex financial derivatives, all chosen because they offer high turnover potential. While trading books focus on short-term gains, banking books hold assets like traditional loans meant to be kept until they mature. Because trading books are exposed to daily price swings, they naturally carry a much higher risk profile than standard banking books. By keeping these assets separate, firms can manage their daily market exposure without endangering their core long-term financial stability. Understanding how firms classify their assets helps clarify how markets move. Subscribe for more finance basics and stay informed.